All right, what I'm going to go over here is the U.S. Patriot Act and anti-money laundering. This is an important part of your insurance exam. They're going to be asking you questions on it. The Patriot Act was essentially established to set new standards and procedures to monitor potential money laundering for terrorist activities. Okay, so the USA Patriot Act was signed in, I believe, October 26, 2001. The U.S. Patriot Act required FinCEN, which is the Financial Crimes Enforcement Network, to establish new anti-money laundering policies for banks, securities firms, and insurance companies got incorporated into this because people can give insurance companies a ton of money. So they want to make sure that the money is coming from a valid source, from a legitimate source, that someone's not laundering the money, right? Because you can see how it would be easy if someone puts like a ton of money into an annuity, right, or an insurance program, and then cancels the program and asks for a refund. Essentially, the insurance company is then writing them a check for that money they're getting back, and it's cleaned money. So the FinCEN and the federal government wanted to monitor and make sure that insurance policies and annuities were not going to be sources of money laundering. So FinCEN requires insurance companies to monitor all financial transactions, report any suspicious activity, and prohibits correspondence in working with foreign shell banks. They also have to, insurance carriers also, because of this Patriot Act, are required by FinCEN to incorporate pretty strict customer identification programs and customer identification verification processes. So part of the anti-money laundering program includes the following. So insurance carriers have had to implement internal controls to make sure they've had to assimilate policies, procedures, and internal controls for in-house risk assessments, meaning the risk assessments have to be done in-house by the insurance carriers. They've had to institute anti-money laundering programs similar to banks and securities firms. They had to file suspicious activity reports, or SARs, if there are suspicious transactions, which we'll get to in just a little bit. And they've had to appoint qualified compliance officers to monitor the anti-money laundering programs. So these insurance carriers have had to hire people to specifically monitor and make sure that these anti-money laundering programs are compliant and that they work. Also, insurance carriers have had to implement continuing education courses for anti-money laundering so that their agents and staff understand what the policies and procedures are to monitor money laundering and follow the anti-money laundering rules under the U.S. Patriot Act. The insurance carriers also have to allow for independent testing of their anti-money laundering program on a regular basis from outside sources. So there are a few rules for filing suspicious activity report. So suspicious activity reports were implemented to make sure that if there's any potential suspicious activity going on, that the insurance company could file a report saying, hey, there are some transactions here that seem a little fishy. Now, there are some rules to when you have to file a suspicious activity report. So it's any transaction over $5,000 if the insurance carrier knows, suspects, or has reason to believe the following: that the transaction has no business or lawful purpose, if it's designed to deliberately misstate other reporting claims, if it's designed to deliberately misstate other reporting constraints, if it uses the financial institution or insurer to assist in criminal activities, if it's obtained using fraudulent funds from criminal activities, or if it's intended to mask funds from illegal activities. So essentially, any transaction that's $5,000 or more where the insurer has reason to believe that the money was obtained from illegal means, or it's being used to kind of move around something, or it's just suspicious and fishy, like it's just a weird situation. Now, with the weird situation, there are some red flags that the insurance carriers are going to look for, and that you'll want to look for as an agent if you're dealing with people who are giving you large sums of money, $5,000 or more. So, number one, if the customer uses a fake ID, or if they change their mind after they realize that they have to give you an ID. If two or more customers use similar IDs, right? If people are using IDs that look the same or they're trying to use the same ID. If the customer conducts transactions that fall just below the constraints. So say they're like, I'm going to give you a deposit for $4,999.99. It's like, why didn't you just give me $5,000? Because that's the threshold for the suspicious activity report. So that's a little fishy. Another thing is if you have 2 or more customers trying to work together, or if the insurance sees 2 or more customers trying to work together to break up transaction, right? It's like if 2 people want to go in and give a certain amount of money for something so that each of them falls under the total threshold that would allow them to, that would require a suspicious activity report to be filed if the insurance company thought it was suspicious. So when you have a couple people working on the same transaction and breaking it down to kind of try to evade minimum requirements. Another one is if the customer uses 2 or more locations to deposit money or withdraw money or send money in the same day, right? So that they can break up their transaction to fall below the reporting threshold. So if they use, like, say they wire the money with one bank and then they wire the money with another bank and then wire the money with another bank, it's like, why didn't you just send it all with one bank, right? Now, that all these reasons, they don't require you to file a suspicious activity report. They don't require the insurer, I should say, to file a suspicious activity report. But it is something to look out for, where if these things come up, it's like, hey, why did this happen? And if it seems kind of weird and fishy and the person can't really explain like why they did some of these things, then it may warrant the insurance company to file a suspicious activity report. So these reports take place on FinCEN, which is the Financial Crimes Enforcement Network, Form 108, and the reports must be filed within 30 days of discovery of the suspicious activity.